your thoughts on loans right now. Just what is going on?
Yeah, well, first off, the loan market has structurally changed, right? You've had a market that has shifted from maintenance covenants to incurrence, so the old covenant light dynamic associated to that. But the credit quality has decreased as you've seen more LBOs come to the loan market, and inherently the market is more levered and it's a more riskier element. And then thirdly, I would say, instead of 2 years ago, we've had a rising rate environment, we've had an environment where LIBOR is declining. So all of those things are negative from a loan market perspective. So within the loan market, though, I'd say there's a couple different stories which are not different than the rest of the broader markets, including credit, is higher quality is still doing okay. It's the lower quality part of the market which has grown that has really bifurcated and has been pretty negative. And so we continue to, I would say, be cautious across the market. And loans generally look a lot more like a secured high yield bond market than they did the historical loan market. So there are areas and pockets that you can find good spread and good risk in the loan market, but similar to the high yield market, you got to be careful.
Kathy?
We haven't liked the loan market for quite some time. First of all, why are you buying loans when rates are going down?
Well, that would be my question. Is this about floating rate? The pain we're seeing at the moment, is this about floating rate and no appetite for it, or is some credit risk building?
I think both. Both. You've seen a decline in credit quality, and you've seen falling rates, and this covenant light business, you're finally seeing investors push back on it and deals not getting done. So the combination just says why be in the loan market?
Colin?
Well, I think Jim's point about finding the right bonds is really the most critical piece of the puzzle. So in general, don't like leverage loans. But, again, the point Jim made about it now looks more like the high yield market, well, you just got to be careful and make sure that you're involved in the right securities, that, okay, I'm getting paid for the fact that these securities now look like true high yield.
Some of the issues, Jim, that we're seeing in leverage loans right now are quite similar to what we saw at the end of the year, the back end of 2018. What's intriguing about it, though, is that the back end of 2018, more broadly, the fixed income environment was a bit of a mess. The primary market had completely shut down. We're seeing these issues this time around when the rest of the fixed income universe is doing pretty decently and spreads are still tight. What does that tell you?
Yeah, well, first off, I disagree with the comment. When you look at the underlying, if you looked at double Bs in high yield, they're at their kind of their 2 percentile of the last 10 years. Like the spreads are at their tights. When you look at triple Cs in the high yield market, they're at their 75th percentile. Right, so there's a lot of bifurcation in the high yield market. If you look at energy, it's towards its wides and is really weighed down in parts of the high yield market. So you're seeing the same thing in loans. You just don't see the same differentiation of return because it's a front end spread product, right? So I think in the loan market, as we talked about, credit risk has increased. And there are certainly areas of the loan market that I think you want to be careful of negative convexity, meaning that when there's an earnings miss, it is going to trade similar with downside risk like a high yield bond. And there are others that it's not about the floating rate, it's where can you find good spread risk, right? Where are you finding good securities that ultimately can achieve returns? And you should be able to find a 4 or 5% return in the loan market. I wouldn't necessarily look at it and say buy it in isolation. I think that across the markets in credit, there's a lot of dispersion. And if you can utilize the high yield or loan or different regions, you can really capitalize on that, basically creating good income and avoiding downside risk to bad business models.
Kathy, build on that.
Well, I disagree, to be perfectly honest. I think it's when and if the market turns, this differentiation isn't going to help a whole lot. And so the loan market being as it is, I would say you're better off moving into high yield than you are staying in the loan market.
Looking at high yield through this year, we've had 3 scares. We got close to the tights of the year in and around 350. Spreads blew out. Didn't even get to 450 this time around, Kathy. What does that tell you?
It tells you that this search for yield is still really intense. And as the Fed lowers rates, people are going to continue to pile into things that offer yield irrespective of the quality. And that's why we've been pretty cautious on high yield as well for the last 6 months or so.
Any reason to believe that demand goes away, Jim? Every time there's a scare and spreads start to break out towards 450, the buying comes back in. Any reason to believe that goes away anytime soon?
Not at the micro level. I think those are macro factors that are what could potentially pull the market into a recession. And if you have a recession, I think the broader credit spread markets will sell off. So we still put a lower probability to that, but when you think about those scares that have really pulled the triple B market or the double B market down, it's really a fear of an earnings recession or an economic recession, and I think those are the things that you want to watch. Again, I think, as we can talk about the loan market being negative, it's still up 6% for the year, which is a pretty good quality return when you think about all of the negative noise around the whole space.
Final word here, Colin.
Sure. Insatiable demand for fixed income, insatiable demand for high yield fixed income. And not like the old days when a high yield portfolio manager in a time of stress, you mentioned the times of stress, would be worried that they can't raise enough liquidity. High yield portfolio managers now are scared, I can't get those bonds back if I sell them. That's a huge transformation in the markets right now. Very supportive of high yield. We like high yield, and I think that's going to continue into next year.